Hi, happy Tuesday, February 11th, and welcome to Chart This with Dave Keller. I am your host, Dave Keller, coming to you from a beautifully clear, still a little bit snowy Redmond, Washington. Thanks for joining me here every weekday after the close as we try to make sense of these markets together using the best practices of technical analysis. Reviewing the markets today, sort of opened weaker, finished decent upside for the major averages, particularly the S&P just getting back to flat was kind of a big win. You're going to see that some of the value sectors outperform some of the more growthy sectors, which is certainly a theme that we've been highlighting for quite some time. Defense very much getting it done versus offense. When you look at consumer staples as the top performer and consumer discretionary the bottom performer. Now you have Tesla weighing on the XLY. You have some of the defensive sectors like Coke and other consumer staples names having some decent earnings, which is propelling a bit of an upside there. I arguably, when I take a step back and try to assess things, this is very much still a market in transition. I think the themes we've been talking about so far in the last 3 to 4 weeks still very much alive and well. And it strikes me just in the last couple days, we've had comments, we've had all sorts of news in terms of the Doge and all of the changes in policy and spending that I feel like every day is bringing multiple new significant headlines along those lines. Tariffs being announced randomly and with little to no warning before impact. I would argue this is one of those times when looking at charts is incredibly beneficial because it's less about what could happen. And I think a lot of when we hear these different news headlines, it's a lot of speculation about what it could mean. Are things inflationary or deflationary? Will they have a huge impact or a little impact? Charts tell you what impact is actually being felt. This speaks to the changing expectations, optimism, pessimism, euphoria, desperation, fear, greed, all of those things, I would argue, best represented by charts and by price action, because that is the great arbiter of investor sentiment. That will tell you what people are thinking and feeling about the market conditions, forward-looking, which is how equity markets are designed. And price is a great way to see how those expectations have changed. And what I'm learning on a week like this is even with all the competing headlines, every day, again, feels like a fire hose of stuff to try to make sense of. At the end of the day, what are the markets actually doing in reaction to that? I would argue one of the big themes so far is rotation, and some of the stocks that have been so dominant in 2024 being a little less dominant in 2025, but not really breaking down, right? We don't see a lot of end of the world kind of downtrends, although I did manage to find a couple here and there to share with you on the show today. As a reminder, we are live streaming on Facebook, YouTube, LinkedIn, and X, and I appreciate you so much tuning in live on any of those platforms. I can't see questions that you put in anywhere where you can drop a comment on one of those where you see the stream. I can see your questions here on my platform, and I'll try to take a question or two at the end of the episode. Anything we don't get to, we will put in the mailbag and hopefully get to it on Friday's show. All right, looking at the market conditions here on Tuesday, February 11th after the close, the S&P 500 just narrowly edging out a down day and finishing in the green, although it was just slightly, right? 2 points higher today. So the S&P closing just above 60.68. The Dow up about 1/3%, and so that's a more value-oriented index than the S&P 500. The NASDAQ, which is much more growthy, down 0.4%. So that general theme of value over growth, which we've hit a number of trading days so far in 2025, continues to be the case here. Mid caps and small caps all in the red, and it looks like the S&P 400 mid cap index was the worst performer, still only down about 0.4%. So not a bad day. This is sort of a choppy, sloppy, sideways day more than anything. The VIX did move slightly higher. We're just above 16, but again, in the mid-teens, that is a low volatility environment. The VIX is one of those things down in this area. I don't see a lot of signal. For me, the signal is a push above VIX 20. That would tell me that something is different, something is changing, that there's elevated uncertainty, elevated discomfort, elevated fear, whatever you want to describe it as. But until the VIX pushes above 20, it's basically saying a low volatility environment. Not much to worry about yet. according to the volatility trends. Kind of an interesting day in the fixed income markets. Bonds sold off a bit, down about 0.2% using the TLT. That's a Treasury bond ETF, sort of looking at the long end of the Treasury curve. Interest rates, as bond prices are moving down, interest rates moving up a little bit. So you can see the 10-year yield currently around 4.54 and the long bond yield just below 4.8%. Now, I did grab a chart of the 10-year yield. We've highlighted how on the charts of the TLT, we're sort of in that mean reversion mode, right? We see a general trend of weaker bond prices and higher bond yields so far over the last 8 to 12 weeks. And I would say what we're seeing this week, maybe bonds pulling back after a nice short-term rally, rates actually popping a bit higher, coming out of the lower end of the trend channel that we've observed on the chart of the 10-year yield. We'll look at that in a little more detail when we get to the charts. Dollar index down slightly from yesterday, not a big change there. I mean, stronger dollar remains one of those big risks to this market. Things that I would look for, kind of those red flag movements. VIX pushing above 20 is one of those. The dollar starting to really accelerate to the upside would be an interesting one as well. I did have some questions, by the way, as I bring up the commodity page from some of my market misbehavior premium members about gold prices and what caused gold stocks to be down so much in 2021 and 2022. And I guess the quick answer, the shorter version of a longer, more thoughtful answer that I gave my premium member was basically, stronger dollar, higher interest rates, which was the case in 2021, but definitely accelerated in 2022. And gold had a rough go of things before, obviously recovering and doing quite well over the last year or two. Today, you see gold moving lower, the GLD down about 0.4%, silver down about 0.7%, copper prices were lower. Energy side of commodities up, though. Crude oil, natural gas, both to the upside. Energy ended up having one of the better days out of the 11 S&P sectors. Looking at cryptocurrencies, you can see Bitcoin and Ethereum, certainly the two most widely followed, down slightly today. Bitcoin currently just around 96,300. Ethereum prices around 2620. Boy, a long way below 4,000, which was a level I feel like we were talking about not too long ago. Bitcoin versus Ethereum has favored Bitcoin big time year to date, right? I mean, if you look at the two, Bitcoin's still kind of sideways, but Ethereum kind of clearly trending downwards. A lot of times those two have moved together. This is one of those times when they're kind of not. And even though stocks did sort of have a mixed results kind of session, Bitcoin did rally pretty good here in the last couple hours, but still, again, well below that 100,000 threshold that we've talked about many, many times. Looking at the 11 S&P sectors, you can see in terms of sector breadth, pretty decent day. 9 out of 11 S&P sectors in the green. But it's the more defensive kind of value-y stuff that was at the top of the leaderboard today. Consumer staples, number one, up 1%. And I think that's, primarily an earnings-driven move when you look at the stocks that were up, like Coke and others with good earnings wins this week. Energy, number two, up 0.8%. Materials, number three, up 0.6%. That's not a sector we've talked about too much, but if you'll notice, the tariffs that have come out here recently, hitting steel and sort of in the materials space. We'll look at Steel Dynamics. I forget which stocks I grabbed earlier for the chart review. I remember STLD in particular, so you'll see how some of these are having nice rebounds through this week. On the downside, only 2 of the S&P sectors down. Consumer discretionary, the worst performer, down about 1.1%. Tesla continues to struggle mightily from a technical perspective, dragging the XLY down. And one of the things that we talked about, recently, which I grabbed the chart again today to look at, is the fact that offense over defense has been favoring offense, but it's really starting to change here over the last couple of weeks, particularly the cap-weighted version. And today, yet again, you see the XLY underperforming the XLP. The equal weighted version, still not too much of a warning sign. That's another red flag I'll be looking for, would be defensive sectors really starting to improve. We're seeing some of that, but not warning levels just yet, I would say, on that potentially emerging theme. In terms of the breadth, it depends on where you look, right? I mean, if you look at the NASDAQ composite, you can see 58% of NASDAQ composite stocks down, only 39% up. But if you look at the S&P, which again has a little less of a overwhelming growth tilt, particularly when you do an equal weighted cut of the indexes, which is what you're doing here, just counting stocks up versus stocks down. A little more even, right? 52 up, 48% down on the S&P 500, and about the same for some of the other indexes as well. Looking at the Magnificent Seven and Friends, and I actually did a video for the Stock Charts TV YouTube channel on Monday, and I forget what title we came in, but something like from Magnificent Seven, from Magnificent to Mediocre, or something like that was the title we worked up. So I'll let you take that to a natural a place of where you think I went with that discussion, but basically talked about maybe a rotation away from the Magnificent Seven, and we've certainly seen that, right? We've seen some of those breakdowns in key names like Tesla down another 6.3% today. Netflix coming off of a really good earnings, actually testing 1,000 from above now, down about 1.9%. Alphabet continuing to come back after earnings in recent weeks as well. Apple, the only one really up today in any meaningful way, up 2.2%. And that's part of the sort of tariff story. Actually, Apple, it was discussions in China about partnering to some sort of product announcement. I quickly scanned about 8,000 headlines before we went live, but I saw something with Apple in China that the market is taking quite well, up 2.2%. Meta up about 1/3%, and Amazon not too much different from yesterday's close. All right, let's get to the market carpet, a heat map style visualization. A couple things we'd like to do here. Number one, look at the overall landscape and just sort of see where things are at, then start to drill into some individual stories. So, I mean, this looks like the definition of a neutral day, right? The most common color that I'm seeing is kind of neutral tannish sort of color. So that really shows, even though we've had quite a bit of movement today and a bit of choppiness on the major averages, netted out to kind of a flat day for the S&P 500. And on a day like today, I would say it very much accentuates those stocks that are big movers. That's why I kind of go for this color scheme. And I've looked at a lot of different heat map visualizations. They all have kind of different methodologies of what's up and what's down. I tend to like this one, which Stock Charts calls the vanilla color scheme, only because neutral is kind of, tan beige, which means up a lot is bright green, down a lot is bright red. It's very easy for me to detect those outliers. And that's one of my main goals looking at this visualization. I'd encourage you with whatever platform you're looking at to, come up with some combination that's going to, to resonate for you visually and help you identify those most important movements. But day like today, when the average is neutral, you really start to see the things that are moving quite a lot. So I would say Apple up a decent amount. Other technology names and others like Intel, stand out as being upside surprises there. Again, how Tesla continues to be a total outlier. I was taught that a rising tide lifts all boats, and that most of the movements in stocks are market movements or beta, and then there's a little bit that's kind of stock specific on top of that. But boy, a day like today shows you that Tesla is kind of a Tesla issue, and you can see that by fact that the stock continues to rotate lower. Also noticing within consumer discretionary, Marriott stands out to me. This was an earnings name yesterday or today. We'll look at that chart because I believe I did grab that. And again, we've seen this now how many times during earnings season, stocks making new highs. Like Alphabet is the most obvious one that comes to mind. Literally making a new all-time high into earnings, and then it gaps down. And I don't have to tell you, that's kind of unusual. I mean, it certainly has happened, but I feel like I'm seeing a lot of that. And part of that is just because the markets have been so strong, in 2024, kind of firing in all cylinders going into, this earnings season over the last 3 or 4 weeks. And all of a sudden, these disappointing earnings results really have a glaring downside gap after the uptrend that has been so reliable and so consistent on a lot of these names. Marriott's been a fantastic chart up until today when it gaps lower. Now I think we need to reassess a little bit. You'll see others like Wynn and other names in that sector breaking down. I'm also looking particularly at healthcare because there's a lot more red than the other sectors. Healthcare has its own challenges. I would say, as I mentioned many times, there are pockets within healthcare which have looked quite strong at times, but the general configuration of that sector has been kind of underwhelming. And you see that on a day like today with a lot of different stocks and a lot of different groups showing quite a bit of red. The other one that I would say jumps out, and the airlines aren't bad. I mean, right, if you look at Delta, United Airlines, Alaska. These are some of the S&P names that I see on here in that airlines group. Not bad, and they're pulling back a little bit. Not end of the world bad, but just coming back off of significant highs. For example, here's one. Let's look at Delta, just to completely go off script and change the order. This is what's happening with Delta, and I think the chart of Delta has so many different market themes all in one chart. You have a lot of optimism going into this week, and to be clear, this was their earnings report back here for Delta, kind of at the beginning of the year. But if you look, right, making higher highs, so the trend going into this week has been quite strong. But what Delta Airlines features on its chart is what we've highlighted how many times here in the last couple of weeks, these bearish divergences where stronger price action has been complemented by weaker momentum, and particularly the new highs that we've seen with Delta testing $70 a share about a month ago, mid-January, coming with the RSI not even getting to the overbought region. So we've seen that on a lot of different charts and a lot of different sectors. That uptrend phase, overall is in good shape, and we keep going higher, which is good, but the momentum is weaker. Now, what has happened, though, is if you look at Delta's most recent significant pullback, which was kind of December, right? And then we hit a bottom in early January, popped higher. Earnings kind of provided another little upside boost. Here's a hammer candle right there at the low, second trading day of the year. As we had traded below the 50-day moving average, those hammer candles popping up in a pullback phase are often a great sort of secondary entry point type of signal, a good indication that the short-term pullback is probably over. Also note how the RSI stalled out at 40, which kind of suggests that we're still in an uptrend phase and just in a pullback. So bullish candle pattern as the RSI is testing 40 is kind of a good short-term combination there. Now, if you look, we've pulled back to the 50-day moving average. Again, the RSI heading back towards 40 again. And the question is, do we hold those levels? The RSI held at 40 in December, early January, which is a great sort of indication that that was a short-term pullback within the long-term uptrend. That's what I'd be thinking on charts like Delta and United and Alaska. Some of those, the Jets ETF is a good way to sort of look at that group and seeing some of those short-term pullbacks. Long-term trend is still quite in good shape in some of the overall trend characteristics, but short-term certainly a bit of a pullback there. I do see plenty of questions coming in. Keep them coming. Anything we don't get to, we'll put it in the mailbag for Friday's all mailbag episode. Let's get to the charts here to finish off the show. We'll do the chart review and then take some questions, and we'll be done for a Tuesday afternoon in February. Looking at the S&P 500, again, this is a sideways trend. There's no change to that. If you look yesterday and today's candles almost look identical, had very similar days where we opened near the lower end of the range. We closed toward the upper end of the range, which is good, but we're still pretty much exactly where we've been the last 2 weeks. 2 weeks ago, we were at these exact same levels. Early December of 2024, we're kind of at these exact same levels. So this is a market that has stalled out. I wrote an article for, actually I wrote a newsletter. My newsletter that I send out every week talked a little bit about power on stalls. And if you know flying, a power on stall is something that, I'll digress for a moment. Power on stall is something that you train for, because if it happens in real life, it can be a huge issue. A power on stall can happen right when you're taking off. You're at full power. You're trying to maximize power to the engines, get the plane off the ground. And the problem is if you pull the nose back a little too much when you try to get off the ground, you'll stall the airplane, which means you're basically tipping the wings too far, tipping the angle too high. And as a result, the wings basically can't produce lift anymore. And the nose drops down very, very suddenly. If you're trying to take off and you're near the ground, that is definitely not something you want to happen. So what you do is you go way up in the air, up to like 4,000, 6,000 feet. You make sure there's no traffic around you, and you recreate the condition. So you basically get in full power. You trim the airplane like you're in takeoff mode, and you basically pretend like you're taking off, even though you're way up in the air. And you do it so if something goes horribly wrong, you have plenty of time to recover. Nothing, no one's injured or anything like that. Power on stalls as a new student pilot can be very uncomfortable because you're trying to make the plane not fly. It doesn't feel good. The whole plane shudders. But basically what happens is you're tipping up, and then all of a sudden things come down a little bit. And right at the end, there's this kind of period where you're kind of, you're at max power, but you're not climbing anymore. You're kind of just sitting there before you come down. And the reason why I went through that whole image for you is because that's what this market feels like. Feels like a power on stall. It's like you powered up all the way, you've gotten to altitude, here's your flight path, you've gotten all the way to the peak, and now you're recreating that stall. And again, I'm just maybe have flown too many of them where I'm immediately thinking the nose is going to tip down. That's certainly what this market feels like. And what it reminds you of is that you're basically the momentum, the upside momentum to get the plane higher in the air is no longer working. And that's certainly what this looks and feels like. And I would say the engine of the market has been mega cap growth, right? It's been those magnificent seven kind of leading names that have done so well for so long that the major benchmarks, which are dominated by those in terms of market cap weighting, have continued to remain strong. Now, all of a sudden, that's changing. And excuse me, the average Magnificent Seven chart does not look as magnificent as it had. And there's a meta out there, but there are a lot of others that don't look as good as meta does anymore. And I think that's the concern I have for this market here. Now, a good stall means you don't lose that much altitude and then you regain your footing. And so I think 58.50 is kind of that floor in the market. And as long as we pull back to only around that level, this is still a great chart. I mean, long-term chart is still fine. But in the short term, things have definitely changed. I always tell people, look for a change of character. I think we've undeniably seen that so far in the last 3 months, right? Really from the week of elections to where we're at today has been a very different market. With all the news flow and everything coming out, at the end of the day, it's netting out to a market in a sideways mode. S&P pushes above 6,100 and we start to see improving breadth characteristics. I would say that's totally fine. But that's where I'm at. Power on stall is kind of my base case here. I did want to highlight with breadth. I mean, again, there's no real change to some of these breadth indicators. We're still at about a coin flip 50-50 as to whether an S&P 500 member is above or below its 50-day moving average right about now. And that's okay. That's not a bad number. That's not a, uh-oh, we're in trouble kind of number. That's if we get down in the, 20s, teens or something like that, as we did in December. That's why December felt pretty rough because so many stocks were below their 50-day moving average all of a sudden. We're not in anywhere near that kind of danger zone, but we're also not seeing an expansion in breadth. We're not seeing more and more stocks breaking out to the point that it feels like things are getting better. It's sort of sideways, right? We're sort of in wait and see mode. Maybe the inflation data we start getting tomorrow, Thursday, change the trajectory and start to provide a bit of a catalyst here. We'll see. Now, while breadth conditions have remained fairly flat, I would say the volume conditions overall are okay. Now, it depends on what you look at, right? I mean, here's the SPY and here's the daily volume readings. Red means it was a down close. Black means it was an up close. You can see that there are a lot more down closes with heavier volume than up closes with heavier volume so far year to date. You can see the general trend that the volume seems to be trending lower, particularly on up days, and that's all fair. I tend to use Chaikin money flow, which is an adaptation of that daily volume reading, where it really focuses on where we close relative to the highs and the lows. If you look what's happened yesterday and today, even though the volume was not very strong, it was actually low volume relative to the average for the SPY. But since we closed near the highs of the day, that's considered positive volume because overall the trajectory was higher through the course of the day. So we finished strong, which is a good sign for volume. That means that's good volume or bullish volume. So the fact that the Chaikin money flow is trending so much up basically tells you on those up closes, there are enough up closes on heavier volume that are basically suggesting that the volume conditions are actually okay, a lot better than you would think looking at the general downtrend in volume readings. So again, kind of mixed signals on this one as well. The general tendency in volume has been lower, but the volume, when you look day to day at the particular price movements and what that means or how important that volume is, the up volume is telling us we're in a period of accumulation still. Now, this is a chart we showed on yesterday's show. I just want to show because it's accelerating to the downside. The cap-weighted version is in the top half. This is looking at offense versus defense. As a reminder, if you've not seen me show this before, this is a classic measure of things you want versus things you need. The argument is things you need, like consumer staples, you're always going to need them, regardless of how much discretionary money you have to spend, regardless of how much you've saved, regardless of how good or bad you think the economy is going to be. You still need toilet paper and beverages and cleaning products and personal care products. Those are kind of just necessities that everyone kind of needs. Consumer discretionary are more discretionary purchases, things you don't need, but you want. Travel, new watch, new car, new phone, new whatever. Those would be generally, phone's not a good example because that's probably tech, but you get the idea, right? Discretionary things you don't need, but kind of nice to have if you have the money to spend on it. So if this ratio is going up, that means things you want are doing better than things you need, suggesting optimism, suggesting consumers are spending money and the expectations are that conditions are pretty good. The ratio starts rotating lower. That suggests investors are rotating more to the things you need side, suggesting a more defensive sort of reality. Now, the cap-weighted version has really started to roll over. That's driven by Tesla, Amazon, Home Depot are the three biggest weights in the XLY, and they're all kind of struggling here recently, especially Tesla, which is one of the biggest weights. And as a result, the cap-weighted version is coming down. The equal-weighted version is still okay, but this most recent move down is kind of what you see here. If you see further acceleration at some point, this certainly could start to rotate lower. This is my preferred version at the bottom. As long as this one's still okay, I'm going to say that overall it could be just more company-specific issues with some of the mega cap names that are struggling. But certainly the amount to which, the degree to which that ratio is rotating lower has me, watching this one a little more closely than usual to see if we get that rotation to defensive sectors. And again, today you saw the XLP up, XLY down. This is a chart I mentioned earlier, and we're talking about interest rates. The TLT, arguably, in a downtrend channel, has had a nice short-term rally so far in 2025, but at the upper end of that downtrend channel and rotating lower, this is kind of that chart flipped upside down. This is the 10-year Treasury yield. You can see we've been at the lower end of the trend channel going back to the low-end rates in mid-September of last year. That's when the 10-year yield's down around 3.6%. It did get all the way up to 4.8% in early January, pulled back to around 4.4% today, pushing back higher here. So I'm wondering if this is now rotating off of the lower end of this trend channel, and maybe this is the next leg higher that we see in rates as we aim back toward the upper end of that trend channel. This is a great way of visually showing how a longer term trend can actually have these fluctuations. And that's the swing trading time frame, sort of the mean reversion of the markets. But then this is the longer term time frame, sort of the longer term trends. And you can see how that's particularly going higher. All right, some other charts, and then I'll take some questions. We'll be done. NVIDIA, I'm including on the chart. Just to remind you, as of yesterday, we're trading the 50-day moving average from below. That's back in play today. No real change. Arguably, today's a doji candle, which suggests indecision, which suggests a short-term reversal, which suggests the next 1 to 3 bars more likely lower rather than higher. If we would get above the 50-day tomorrow, that would negate that sort of short-term bearish indication from the candle chart. But I would say overall, we've now had the nice rally off of the early February low. The question is, can we sustain, can we hold that range that we were in November, December, and half of January before that gap lower on the DeepSeek AI news? I would say the 50-day moving average is pretty vital here to see if we're able to regain that. And again, the doji candle that we saw today actually suggests we reverse downside for the next couple of days. Alphabet continued to break down after the earnings miss last week. We can see further deterioration below the 50-day moving average. What's interesting here is we're now approaching the upper end of this gap, which was the early December gap. We saw the gap from around 175 around 181, and then continued to push higher. So we'll see if we fill that gap and get back down to that range. The 200-day moving average is not too far below current levels, around 175. That's about $10 below where we're at right now. And the RSI, literally right at the lower end of what you could say is still a bullish range, between 40 on the lower end and up to the 80, 90 range. But we break anything below this, and Alphabet all of a sudden looks like a pretty broken chart. Now, while charts like Alphabet and others are popping lower, we are seeing some upside movements in some names. This is DuPont de Nemours, DD, reporting earnings today. You can see the gap higher. This is a material stock. Someone mentioned, I saw earlier in the chat asking about the materials sector. And again, I'm finding names that are actually bouncing very nicely this week. At DD up almost 7% today. Today's move higher clears the swing high from mid-January, also gets us back above the 200-day moving average for the first time since mid-December. I think that's a nice upside follow through after making a higher low here end of January, beginning of February. So I like this upside follow through on earnings. Now, potentially, we retest the previous highs from late September. After a gap day like this, want to see the 200-day moving average hold tomorrow. So what you don't want to see is a whipsaw where we go right back below it. So making sure that we hold that and get a bit of follow through tomorrow is pretty important there. Here's steel dynamics. Obviously, steel tariffs coming into the news in the last 24 hours. We can see STLD has actually been in a pretty decent upswing for the year, selling off pretty good right until the end of 2024. Starting on January 1st, all of a sudden that starts to reverse to the upside. A trend line using those swing lows so far in 2025 might be an easy way to sort of play this. You have kind of a parallel uptrend channel that we see higher lows, higher highs, and overall regaining moving average support. The 200-day was resistance, now becomes support. Overall, I think that's a chart in a primary uptrend with the momentum getting up toward the bullish range, which is pretty valuable. Coke gapping higher today. This is part of that XLP over XLY story that we've highlighted a number of times today. KO reporting earnings up almost 5% today. This is called a hanging man candle, which is not particularly bullish. When you have an uptrend and then you have the highs, the open and close right around the upper end, and then a big lower shadow, seems encouraging by the fact that we closed near the highs of the day. But the fact that it's kind of just sitting up there with the open and close right around the same levels is actually not as ideal as you want. I like the fact that Coke has broken above this resistance, cleared the 200-day moving average. Tomorrow, do we hold that today's low? And that's something I would be looking for, just to kind of confirm that this breakout is good and setting up for further upside. But strong upside momentum, improving relative strength. Today's gap higher certainly helps the technical configuration on Coke, which is sort of languishing below moving average support until today. Marriott, another earnings name today, not great, down about 5.4%. This is one of those where, not a great earnings release. However, you can see that we're holding the 50-day moving average as of today, right? So we traded down to the 50-day, didn't break it. So it's sort of like a bent, not broken type of pattern. But the question is, does the 50-day hold? And if it doesn't, 270 is the swing low from January. I think holding that's pretty important. If we break that, I would say from a technical perspective, pretty clearly a distribution pattern from that point on. All right, a couple more, I think two more here. Regeneron, I just want to highlight an example of a stock failing to regain its 50-day moving average. When I have a chart in a consistent downtrend, I'll get a lot of questions on, is this the bottom? Is this the bottom? Is this the bottom? And I always remind people, from my perspective, I've learned trying to pinpoint the bottom is a fool's errand in a lot of ways. Patiently waiting for the chart to tell you something's different is a much more profitable and a much less stressful way of interpreting a chart like this. So Regeneron's still making lower highs and lower lows. It's still below two downward sloping moving averages. An attempt to regain the 50-day moving average over the last week has now failed. I see that as still a primary downtrend until proven otherwise, and it has not been proven otherwise yet. What you're looking for on the chart of Regeneron is what we saw with MDLZ, which is a consumer staples name, which was up over 3% today, again, helping to fuel the XLP push higher. What you want is for stocks like this to regain the 50-day. That's where you say, okay, now at least we've broken above the 50-day moving average. Is there something here, right? Am I seeing enough evidence that tells me this is a constructive chart? Things that I like on this chart that you not see with Regeneron is the fact that we've closed above the 50-day moving average, the RSI pushing just slightly above 60. So we're very close to sort of that rotation from what defines a downtrend, lower highs, lower lows, RSI mostly below 50, to a bullish trend, which is higher highs, higher lows, RSI pushing above 60 on rallies. We may just be starting to see that. So I like how we're seeing a bit of a rotation here. And again, it's not lost on me that these are fairly defensive stocks like Coke and MDLZ having some nice upside moves for earnings right about now. All right, those are the charts that I had handpicked to review. Let's look at some of the questions coming on here. Let's see. I just saw the lady on CNBC. I don't know who that was, saying that she likes Intel. because of a double bottom, and it's above the 50-day moving average. Any thoughts? 3P Investor, thanks for watching on YouTube. I don't know who that was. I'm thrilled that someone's on CNBC talking about double bottoming patterns and 50-day moving averages. I think the more the better on things like that. But what do we see here? Yeah, so I mean, I get the argument, right? If you look at the weekly chart, it's a very clear what we call a double bottoming pattern, and that's where you have a retest of the same level. In general, right, there's two kind of ways that you play this type of chart. I would say from a technical perspective, number one is you buy that second low, right? So if we establish support, we buy the second support level, and ideally that's it. And I would just say use a tight stop because you don't want to break below, because then that means it's not really a double bottom anymore. An example of where that worked really well was kind of back here, right? You almost had like a triple bottom where we had the initial support in October of 22. We retested it a couple times, and every time we hold that, feels a little more, secure. So, buying on these subsequent tests of that level and just betting that we're going to go up before we break to a new low. I get the argument there. That is a sort of a value-oriented technical approach. One of the other ways to do it is wait for enough of a breakout to sort of get above these swing highs. So a more conservative way would be wait for a follow through, right? Getting above moving averages, getting above the swing highs, which suggests we're now making higher highs and higher lows. And you kind of miss out on that beginning move, but at least you're participating in the bulk of the uptrend. So that 2023 is kind of the general playbook you'd be advocating right about now, because a very similar pattern where you test support, you're betting on us not going much lower. I tend to be a little more conservative with charts like this, but I get the argument if you're a little, comfortable buying weakness and betting on that upside movement. I get the argument. All I would say is when you buy things that are at the lower end of the range, make sure you're thoughtful about using, clear support levels, clear stop losses, just in case you're not correct, and just in case the price does not move in the way that you expect. Justin Mamus, famous technical analyst, famous broker, was quoted as saying, if you buy a stock and it doesn't do what you want it to, sell it, or something like that. I'm paraphrasing, but basically, if you have an idea and it doesn't play out how you would expect, just sell it and move on to something else. And his point was, focus on the best opportunities, focus on the big gains. And it's worth noting, by the way, Intel, very much an outlier. It looks very different than most of the other semiconductors, just because of Intel, a little more established business and different than others you may see. Let's see, a number of questions here. Bull Bear Jeff, thanks for watching on YouTube. You asked, do you chart the mags? And I definitely do. I would say, and you're right. I saw a couple of questions about the Magnificent Seven. You can use the mags ETF. It's probably the best ETF that I would say is kind of a pure play on that theme of mega cap growth names. I mean, honestly, the QQQ isn't a bad proxy for that too. If you look at the correlation between the two, it's pretty high because it's looking at a lot of the same names, and the Q is very top heavy into a lot of these stocks, just some different names and different weightings, of course. And certainly when I'm looking at the performance of mags versus others, I think this is a good place to look at it. And again, I mean, this is not a great chart. It's not a horrible chart, right? I mean, it's not breaking down. It's just not going up. And I think that's the big difference from late 24 to early 25 is this right here. When mags is doing this, that is a primary uptrend by the markets, driven by Magnificent Seven stocks, the mega cap growth stocks. That is not what we're seeing right now. And while you still have some that are drifting higher, it's not many anymore. And the other comment I would say about this is kind of grouping them all together. It's kind of like looking at EEM and assuming that that's emerging markets. I mean, it is technically, but China is very different from Brazil, which is very different from developing Asia and elsewhere, right? I mean, you're kind of mixing some apples and oranges in that thing. And I would say there are times when the Magnificent Seven has looked like one big group of stocks kind of getting it done or not. Now you're starting to see some real dispersion, some real differentiation between the names in that bucket, that small bucket that are working still, and the names that are not. And I think be thoughtful about grouping those together, because I would say now it's a much more mixed bag of charts that are working and charts that are not. I'm happy to continue to own the Magnificent Seven stocks that are still working. There's just a lot less than 7 of them here in early February of 2025. Folks, that's it. I did not get to all the questions, but I will put the remainder into our mailbag. We're planning an all mailbag episode on Friday of this week. By the way, when we were looking at offense versus defense, I did catch up with Julius DeKempener for our latest episode of the Market Misbehavior podcast. We'll get that edited up and hopefully released to you probably tomorrow morning. But we did release just a few hours ago our latest episode with Steve Kress, who's the head of quantitative strategy at Seeking Alpha. We had a really good conversation about quant investing, quant models, quantitative versus fundamental and technical disciplines. If you've never used a quant model or don't really understand what that means, it's a really good episode because he describes the challenges of analyzing companies fundamentally and how quantitative models can help you look much broader and cast a much wider net to look for potential opportunities. So look for that posted on our YouTube channel. That's it for today for Market Misbehavior. I'm Dave Keller. Have a great night. And remember, it's always a good time to own good charts. Take care, folks.